Hi everyone, welcome back to the Attract Capital webinar series. I'm your host Sarah and I am here with Attract Capital CEO Dave Barnett. And today we're going to talk a little bit about typical financial covenants for middle market financing. So starting off, Dave, I think we need a little bit of a definition. So can you explain what covenants are?
Sure, Sarah. That's a very good question. Covenants are financial guidelines. They're financial metrics used by lenders to ensure that the company that they made the loan to is performing. And they measure the profit trends, they measure the leverage credit position of the company at certain points in time. The lenders use them to manage risk because if you trip a covenant, if it's something serious, it gives the lender some remedy and some recourse so that they can take action, they can protect their interests. So there's simple covenants and there's more important covenants, which the financial covenants are.
Mm-hmm. So can you get a little more specific of what the financial covenants usually are?
Sure. So there's a debt service coverage, there's a leverage ratio, and there's a minimum EBITDA level. And debt service essentially measures how much money is coming in versus the interest and the principal payments that you have to make. The leverage ratio measures the amount of the debt divided by your EBITDA. So it looks at how leveraged you are, what your credit standing happens to be. The minimum EBITDA is just the level of profitability that you're achieving. That's what these covenants are. Usually the debt service runs at around 1.25 times your fixed charges. The leverage multiple is sub 3.5 times. So your debt should be less than 3.5 times your EBITDA. And your minimum EBITDA is very subjective to the type of company that you are. But these are the general financial guardrails that the lenders use in order to kind of benchmark the health of the loan.
So this is kind of what people could expect to see, but I know they got a lot of information there, formulas and stuff. So if you could kind of synthesize it and say what the most important things to bear in mind are,
okay.
How would you describe that?
So I tell all my clients who are entering into this type of a lending relationship for the first time, not to be afraid of the covenants because you're likely to trip a covenant over the life of the loan because the covenants might not be perfectly set and you might have a performance hiccup that may result in you breaching a covenant.
And lenders might even expect that,
They expect it, and what it does, Sarah, it gives them the ability to communicate with their borrower
Sure.
and to learn the underlying causes. If it's just something simple or something minor, they're not going to care. But if it's something major, if you lost your biggest customer, then they're going to get very involved and they're going to be very concerned. So the other thing you want to make sure of is that you want to know before you even get to the numbers, you want to know how the lender behaves in a covenant tripping situation. So if you trip a covenant, are they going to sort of call the loan? Are they going to send you a nasty letter? Are they going to accelerate the loan? Or do they have a history of being more relaxed and
Sure.
measured in their response to your tripping the covenant? So the behavior of the lender is critical to understand. And you also want to make sure that when you're looking at the covenants, when you're calculating them out and when the lender's calculating them, they should give you a copy of their file. You want to make sure that you're working from the same set of underlying assumptions.
Sure.
And that there isn't any one covenant that is more sensitive than the other, because that can create problems for you.
Yeah.
But by and large, covenants in the deals that Attract Capital has been involved in are largely benign, and they're used as a device to foster communication and dialogue between lender and borrower. So if you have a good lender relationship, then you really shouldn't fear the covenants, but obviously you want to get them right and you want to get them as borrower friendly as possible.
Sure. And so I'm assuming people watching, if they have more questions, they can come to you to understand a bit more?
Absolutely, they can come to me, Sarah.
Of course they can. So there we have it. So thank you guys so much for coming, and we will see you at the next webinar.
Thank you.
Bye.